If you bought a property in 2022, there may be a chance that you're already underwater with respect to your mortgage payment. That's right, no equity, negative equity. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy here, putting the realism back in real estate. Today's the 12th of April. Hope you're doing well. Stick around for a bit. I got a really cool thing I want to share with you on this video. And this video is brought to you by our friends at Foreclosure.com. If you want to check out the cool things you can find in your backyard, your zip code, all the distressed properties that we talk about here on this channel, go to gethousingdata.com. That's gethousingdata.com. All right, so a tenth of recent home buyers are underwater on their mortgage. Homes bought with small down payments this past year are likely to be worth less than the debt owed on them. Say it isn't so? Well, it is actually happening. More than 1 in 10 homes bought in the past year are worth less than what the owners owe on the mortgage after rising prices and higher interest rates drove people to borrow using Federal Housing Authority and Veterans Administration loans that need smaller down payments. That's obviously FHA and VA loans that we refer to on this channel. About 11% of recent home buyers had properties worth less than the debt owed to them on them on February. Many of the underwater loans require much lower down payments than conventional loans. So obviously, you get into the loan products easier, less money out of your pocket to acquire the property. But on the flip side, there's no equity. So when the property values slide, and say you want to sell, closing cost commissions, oh, I'm negative on my mortgage, you can't sell unless you're bringing money to the table to close on that deal if you want to sell. So problematic for some people. About 11% of people who borrowed to buy homes last year owed more than the properties are worth. In February, it's a figure that's grown since 2021, and the figures from Black Knight Financial. It's far higher than the 1.42% figure as the market as a whole. As home prices rise, borrowers are struggling to meet down payments, which is understandable. All right, so a recent poll from Insurify found that more than 1 of every 4 respondents who purchased a home in the last 11 months have properties worth less than the loans on them. National delinquency rate was about 7 percentage points. It rose 7 points in February compared to January. It was down 13% year over year. The number of borrowers who were 30 days delinquent rose in February. The number of Americans 30 days past due rose by 19,000 in February compared to January. So yeah, delinquencies are happening in the marketplace. Now, interesting enough, though, I did a video on this a little while ago because Black Knight Financial is providers of this information for this article. Over the past couple of years, I've talked about forbearance, foreclosures, the volumes, the delinquencies, the whole bit. I have found that Black Knight Financial tends to be a lot more, we'll call it, light on their data, so to speak. All right. So I'll look at other data providers and I'll see larger amounts when they're talking about the same thing. So whatever these guys say, take with a grain of salt. It's usually more than what they're leading on. Now, with respect to FHA loans, well, earlier I had a video that said, EPD had a massive increase. What's EPD? Early payment default. All right, that's not what you're thinking it is, right? Early payment default, massive increases were just like the 2009 levels back in the day in the last housing crisis. So is that a little bit scary and problematic? I would say so. And about 25% of FHA loans, according to that article, said that they were already underwater. So when we're talking about 11% or so, 10%, that's across the board. Obviously, the FHA component of all those loans are underwater will have a higher, obviously a larger component of the delinquencies and of the underwater. Just keep that in mind. All right. So interesting enough, right? So if you guys recall, I did a video about this November 10th, 2021. And this video was basically about me walking through a zombie foreclosure property. It was a big mess. I had my mask on. I was sweating. I looked like a mess. It was hot as heck in there. It was awful. So if you guys didn't watch it, I suggest you go back and watch it because something really cool is going to happen with this property. So if you take a look at some of the pictures, yeah, the place is overgrown. It's been vacant for over 10 years. It was a true zombie foreclosure. You can see the big mess, okay? It was a mess inside. Oh my goodness, mold, broken into, glass shards everywhere, drug paraphernalia kicking around, like all sorts of interesting stuff was going on in that property. But it was an opportunity to actually make something good out of a bad situation, which we actually did. So why I'm talking about this, and again, this is a bit of shameless self-promotion, is that this property is actually going to appear on an episode of A&E's Zombie House Flipping. It's the actual Tampa franchise. I do know 2 of the cast members in the Tampa franchise. So A&E has done Zombie House Flipping. I don't know if you've seen this program. Basically, take yucky, nasty, beat up houses, and they fix them up and resell them to real buyers. But they do a good job at fixing all the problems and dealing with all the issues. So I work with two of the cast members in the Tampa franchise. There's three franchises: the original Orlando franchise, one in Dallas, and one here in Tampa. So basically, we were able to sort of move this property to that group, and they were able to do the work on it. So I'll be clear here. I'm not in the TV show. But I thought it was interesting so you could see that, if you saw my video and what it looked like walking through and what the final product's going to be, you're going to be quite amazed. They did a really good job on the property. So again, this will be on Saturday, April 22nd, 2023. That's what I've been told by one of the cast members. So that's the day that's the day that episode will air. If you're on Eastern Standard Time, it's going to be 11 a.m. Typically, this show goes on the mornings, on Saturday mornings. So again, if you can check it out, I think it's kind of a cool little thing that I'm involved in here. But again, my property, so to speak, I did the work to get it negotiated to a great level. Had a lot of debt on it. Had two mortgages. Had tax liens, code violations, a lot of stuff going on. So it was quite the project, quite the case study. But you're not going to hear any of that on the episode, by the way. But I just want you to sort of go through and you can see the before and after. This is the type of stuff I do, and I can get massive discounts on these type of properties. And I'm working on a few more for these guys as well. So that's kind of what I like to do. This was kind of came out of the blue, unexpected. So, hey, we'll roll with it, see what happens. Again, a little shameless self-promotion that I'm glad you guys are letting me indulge myself in here. So I appreciate that. Okay, so if we're going back to the video here, again, another article about the alarming number of new mortgages already underwater. It was kind of that same article, so same Insurify article that came out, so different somebody writing on it here. But so we know that price points are going down. We know that people are becoming more delinquent, and it's causing problems for a lot of people. Well, here's the deal: is that these guys, Insurify, are clearly involved with home insurance. They're talking about the fact that the Insurify group projects home insurance rates will increase an additional 9% coming up, followed by 7% from the previous year. So when you take a look at things like, well, okay, interest rates are up, all of our expenses are up, we're having problems with income, inflation, everything is high. Well, we know property values were up. Now, yeah, they're coming down, but they still are very high. Interest rates are up, which is making it tough. Well, guess what? Your insurance went up 7% across the board last year. Your home insurance is projected to go up 9% this year. That's going to affect your mortgage payment, because now if you get a mortgage, typically what they do is they escrow your taxes, insurance in the mortgage payment. So basically every component to buy a house is making this whole entire market completely unaffordable for a lot of people, which is not a good thing. So going to their article, new homeowners are already upside down on their mortgages. So negative home equity based on year's purchase. So a year ago, you see that you've got people who are upside down their mortgage over 20%. If you bought a year ago, less than a year ago, and that's the purple, those that are concerned about being upside down, or the kind of that gold color, you can see 1 to 3 years ago it's higher, 4 to 9 years ago not so much. But their concerns, 10 or years ago, not as concerned because they've got some built-in equity, right? You bought your home about 10, 11 years ago, you doubled your money, all right? Simple as that. So it's just interesting to see that there is problems here. When you start adding all this up, it does make a difference to people when your final mortgage payments and what you're trying to do is difficult. It is highly unaffordable. And also, we don't tend to talk about this. Well, property tax is also increasing by, on average, 4% greater across the board. So yes, they escrow your insurance, they escrow your property tax. So property taxes are increasing. Some locations will have greater property tax than others, so that's problematic. So in the end, your interest rate's high, your price point, your purchase is high, your insurance rates are going up, and your property taxes are going up, all right? So, and guess what? That's now, and when you buy at a higher rate, then next year they're going to reassess your property taxes, and those are probably going to go up as well, even more so. So, pretty tough buying a property these days. That's why you got to wait to, number one, mortgage rates get a little lower, and two, we see some material price points and more sliding in home values to make it affordable for the average person that's out there. Simple as that, guys. So, by the way, if you enjoy the information I provide, if you could actually hit that subscribe button, subscribe to my channel, I'd really appreciate that. And you know what? If you are already a subscriber, if you could reaffirm your subscription, hit it again, do that bell notification, because I lose subscribers every day. I've listened to other channels out there that have same things happening to them. It's just a YouTube thing, right? Wink, wink, nudge, nudge. So I just lose them every day. So if you could resubscribe, that'd be great. And I appreciate everybody watching the video. So thank you very much. Just to kind of cap this off here, with respect to these mortgages, so if you've got people who are already delinquent on their mortgages, it's interesting because independent mortgage banks and mortgage subsidiaries of charter banks lost on average $300 to $301 on each loan they originated in 2022. So basically, it's down from an average profit over $2,300 in 2021. So now they're losing. So the first time since the inception of this report in 2008, net production income for loans was negative or in the red in 2022. Production revenues declined in 22, but the bigger story was that production expenses ballooned to a steady high of $10,600 per loan. Companies could not adjust their capacity fast enough. The number of production employees declined, but not the same pace as the origination volume. So right when the mortgage rates went up, people stopped getting loans, stopped refining. All these staffing people were there at these all these lenders and these loan houses, and basically you start to see massive layoffs. So what happens is, in the net result is you've got an industry who had to cut back staff, who basically lost money on loans. And again, they didn't make money. They lost a big time amount of money on the production value of the loans. And now a lot of these loans now are moving towards a default stage. So in the end, it's not good for the mortgage industry as a whole, and not good for the real estate industry as a whole when you start to see where this is going to go. I just wanted to point that out. So anyway, folks, that's it for this video. I won't keep it too long. I'm going to start doing more videos. I got so much on the go here. There's so many things happening in the marketplace right now. I touched my last video. I touched on the commercial crisis, which looks like it's actually starting to happen right now. All these things are going on in the marketplace. It's really going to push home values down and really have a big issue with our economy. So be prepared and be in the know so you can take advantage of what happens when things slide and start to hit to the bottom. All right. So once again, thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. I look forward to speaking with you later on this week. Take care.